So we've got a very good, interesting panel here with a good cross-section from the industry and also from the SEC as well. And so I think we should get down to it. And I suppose let's start by just sort of posing this question. Why do so many people seem to suggest, or basically come out and say, the market is rigged? And just maybe go down the panel and get just maybe one sort of from each person. Why do they think this is such a topical and such a hot button issue? And I suppose the backdrop here is we've got record stocks. We've nearly tripled in value in the S&P since the lows of '09. Yet trading volumes are now the lowest since December of 2006. There's no real, you sort of look back to the late 90s when we had that great bull run, and even in the 80s with the bull market, it's such a different atmosphere when you look at the stock market and the performance of stocks. And yet there's this undercurrent of disenchantment with the way the market works, of sort of fear of technology, even though it's in all our lives and benefits us in so many ways. So I just thought that might be a good way to sort of start things off and just go down the panel. So, Robert.
Yeah, I guess my theory would be that you're dealing with a little bit of mystery today. I grew up my first job coming out of Georgetown actually, was before the New York Stock Exchange, and it was a floor clerk. And back in the day, a floor clerk was pretty easy to understand, right? We took orders over the phone. There was what I used to call the bucket brigade, right? There was the client, the sales trader, the block trader, the floor clerk, the floor broker, the specialist clerk, and then everything went right back up through that chain. To reference Dan's comments earlier, we would argue it's a much more efficient market than it was back then. Certainly a lot less information leakage. I mean, that's all intuitive. What's not intuitive is how the market discovers price, how market data is disseminated, the black box, the propeller heads, the quantum physics that's going on in the marketplace every day, the arms race, if you will, that exists around latency. All those things are very mysterious to the average investor, the average retail investor, as they should be. So I think a lot of what we're dealing with here, and certainly Flash Boys is a provocative exercise in terms of exposing a lot of things that are going on, maybe not so accurately at times, but certainly exposing a lot of things that are going on. It creates this mistrust amongst the retail community, and let's face it, perception is 9/10 of the law. And I think what we're dealing with is a lot of perception issues. When you start to dig into the data, however, as Commissioner Gallagher once again referenced, and as the chairman referenced in her speech in June, it's not a bad market. The evolution, the natural evolution, the technology that's been applied to the business, and the disruption of that bucket brigade has actually added a lot of value back to institutional investors. And institutional investors are retail investors because mutual funds are held by, I guess the number that the ICI throws around is something like upwards of 70 million people in the country own a mutual fund. So that is the retail community. So I think it's really about holistic review is great. I think from the perspective of I think disrupting this narrative that's in the marketplace today. And so I think it's intuitive that the market's mysterious. It's dark. I hate to use that nomenclature. But it is dark, and it is a place where I think folks are having a really hard time understanding how it operates on a database. When they hit that button in Schwab and they buy 100 shares of XYZ, they get an immediate response. And I would argue, because I do it myself, I would say that is a quantum leap from what it used to be. But that having been said, they don't know anything that's going on in the background. There might as well be the Wizard of Oz, basically pulling a lever and giving them an execution back, because that's about as opaque as it is to them. So I think we have to be sensitive to that. I think we have to be intuitive, and I think a lot of the efforts that are afoot, whether or not they're going on within the industry or exchanges or the buy side, clearly the BlackRock letter that went out last night to the chairman is a very, very important one, and I think is reflective of some of the largest asset managers and their views in the country. And certainly the regulators have a big role to play here in terms of, I think, correcting some of these, as I said, misperceptions in the marketplace.
So turning to the regulator.
So I should start with the standard disclaimer, and I'll try to do it at the beginning as opposed to Dan, who did it at the end. I think that's, I think you hit it. It's a couple things. It's clearly complexity, that the markets are much more complex than they have been historically. While at the same time, I think investors have more oddly enough, have more transparency into just how complex it is, right? So I think they never quite understood it, 10 or 15 years ago, but they thought they did. Now they can see that the markets are, there's multiple venues and there's different types of traders and it's all very complex and they don't understand it, but they know they don't understand it perhaps more than historically they didn't realize that they didn't understand it. And so you get a level of suspicion that goes along with that. I also think, look, we can't ignore the fact that 2008 wasn't that far, wasn't that long ago, and it wasn't that far in people's history. So I think there's a bit of skepticism about the markets generally, about financial services generally, that adds to this idea, if I can't understand it, it can't possibly be fair for me. And so Robert's exactly right. I mean, you look at the investor experience has never been better. And as we start to undertake things like holistic reviews, we have to be very careful that among the things we do, one of the things we don't do is degrade the retail investor experience, or if we do, we're making a very careful, eyes wide open decision around, maybe one class of investors could do better if one class of investors maybe gets degraded slightly. Those are very difficult questions, but we've got to make sure that we appreciate, whether they appreciate it or not, just how nearly seamless in almost all trades the retail investor has an experience. And so I think, that's part of it too, is you've got to turn a little bit of a deaf ear to react to the notion that it's rigged, because in fact, most people are having a very good execution experience in the equities markets.
And to add to that, I would say, why everybody has an opinion about the U.S. stock market is the product that we represent really is a public good. Similar to water, clean water, or electricity, it's a foundation of our society, but we take it for granted. But how things change and how your portfolio is handled, that's a very passionate subject for the general public. So if I were to break it down into themes about why there's such a hysteria, I would say maybe break it down into 3 C's, which is, you already talked about it, complexity. We have over a dozen exchanges. We have dozens and dozens of ATSs. There's the appearance of conflicts. So there's conflicts have always been in this business. There's conflicts in every business. How brokers route orders. Are brokers taking advantage of me? Are brokers protecting my pension fund? Am I as a retail investor? What's with these robots? Are they taking advantage of me? And then it really kind of comes down to confusion. You add all of that up, throw in a book by one of the most famous writers in the United States, and it has a lot of themes of attack of the robots, and it can create something, which is quite confusing. The other thing that I would say is, when we look forward towards the march towards progress. Now, obviously, there's been some embarrassing public meltdowns, whether it's Facebook or the flash crash. These are very big scars to the industry, but let's also not forget, how far we've come. And there's also this sort of cottage industry that sits outside, I would say, the sort of the day-to-day industry and the business that are always critiquing, and obviously with blogs and the proliferation of social media, it's very easy to spread your opinion, even if you're the tiniest minority, and that's where we wind up.
It's always hard to go last after these guys, but I'll just add a few things. I think they did a great job of summarizing the issues. Couple of things. Whenever you have massive transformation like we've had over the last 15, 20 years in the market, first of all, there is complexity, there's confusion, but there's also winners and losers. And from the intermediary standpoint, that's true. And so some intermediaries, I'm not saying they make up stuff, but I think they believe that careers were taken away from them. They believe genuinely that the market is not better, and that it's worse, and that things have changed for the worse. And even market participants outside of intermediaries, the people who own stocks, have really been underrepresented in this rally. If you look at it in terms of pension fund exposure or in terms of retail investors, it's pretty striking when I look at our strategists' work on that. So people, there's a little bit of sour grapes at times, or people, and then people looking for a boogeyman. Who's at fault? And it's easy to blame the robots. It's easy to blame nameless, faceless people. And the other thing I'd say is it's very frustrating for folks like this on the panel to see the way some people manipulate data these days or use data. There's a quote I saw last year that I really loved that, and I feel this is true. A lot of people are using data like a drunken man uses a lamppost for support rather than illumination. and I think we see that a lot in our marketplace right now. And for people who are data-driven and want to be, including the SEC, it's frustrating. And I'll just bring two simple examples up when we talk about some of these, even the figures you cited. Okay, we're at our lowest in volume since December 2006. Okay, well, really what happened is in 2008, 2009, we had tremendous volume spikes because of the crisis, because of the volatility. We were having 10 billion shared days. When you look at the volumes, really you have this big spike in the middle, and we're just back to where we were pre-crisis. Secondly, if you do it on, instead of just using simple volumes, you do it like the rest of the world does and do it on value traded, it doesn't actually look bad at all. So volume is a simple example there of where you can take data and say, oh my God, we're at the worst place since December 2006. And we track those, and we cite those figures as well. But we try to peel back the onion a little bit and look at it. And another one would be assets under management themselves. There's definitely been outflows from mutual funds. But let's look at the total market. Let's look at ETFs. There's been a transformation of the asset management industry in the way people invest. So when we would see the figures that people would say, well, since the flash crash, X hundred billion have left the market. We'd say, okay, well, let's add ETFs, even just equity ETFs to the equation, and you'll see that, oh no, actually money has been added to the market. So I think data can be manipulated, and I think that makes it easier in the era of blogs and websites and people who can write, famous people who can write books, and they can take data, and frankly, not only take data, in the book, there were several places where he just added zeros to make the problem seem more bigger than it was. It's not that he didn't identify some real problems. Most of it was stuff that we already knew about in the industry, and a lot of it was really hyperbole. So.
Great, thanks, Joe. So Commissioner Gallagher talked about a holistic review, which is something that a lot of people in the industry have been calling for a number of years. It looks like it's now about to get going. What is the one thing, I suppose everyone's calling for a holistic review, but eventually the more likely outcome is that not everyone's going to be happy with whatever comes out of this process, and that everyone has different agendas. The market itself is driven with conflicts of interest and self-interest. But what would be the one thing that would be an absolute game changer for the equity market via a holistic review? What could the SEC do? And maybe
I'm going to listen to the answers on this one. I'm not going to.
But what is the industry looking for here?
I don't know if there's one thing. I think there's a methodology, I think, or an approach, I think. And I think the good news is, and I'm not saying because Steve's here on the panel, the commission, we're in a great spot with the commission right now, between the chairman and the two Georgetown alums, Mike Pior and Dan Gallagher. And so we've got a group, I think, that could have easily reacted to Flash Boys, but didn't. And I think that the methodology or the approach that I suspect they are thinking about, and I don't know for sure, certainly, but I would, given the tea leaves that we've seen so far, is an empirical approach, a data-driven approach, experimentation around trade at and, for instance, increment size in small micro-cap stocks. That's all good. I mean, I have probably some preconceptions, like everyone else on the panel, about what's going to happen, right? What those things are going to lead to. But the fact of the matter is, to experiment with probably less than 2% of average daily notional volume in the equity market, and then to come back and review that and analyze it and apply the lessons learned, that's all good. So I think that this is a commission that is very focused on the notion of do no harm. Right? So there's some very good things going on. Let's make sure that as part of an holistic review, we do no harm. I think Dan obviously has three things that he's focused on, but I think in terms of thematically, the things that are, I think, most important to industry participants is that we do not basically regulate through anecdote. If you read Flash Boys, you could easily react and regulate through anecdote. Well, we got to stop that, right? Well, why? And what problem are you trying to address? So I think those are the things. When I think about the holistic review and the way forward, and the market participation, buy side, sell side, pension funds, all the constituents that I'm sure that will be gathered around that table with the regulators. I think that's really the fundamental principle that needs to be applied.
So I guess I would add, as far as the holistic review, it's hard to picture exactly where we're going to start. I mean, Commissioner Gallagher himself said, well, that's really up to Chair White on where we begin. But you're starting to see us, we call it pick around the edges, but the tick pilot's one great example. But the major themes in the industry are all being, I think, attacked one by one. Another example is transparency. And we talk about the regulators potentially being outgunned and not having the data that they need to keep up with the advanced pace of technology. Just speaking as an SRO, we're working on the consolidated audit trail. It's a massive amount of work for a massive amount of data. And these things, it's going to take time. But what that brings me to is that when we think about issues like high-frequency traders or conflicts of interest, our brokers, really doing right by their customers, really it does come down to shedding light on how orders flow through this vast, complex system. So I do think we are attacking these issues one by one. As far as a holistic review, it does come back. Everybody, I think, in the industry is agreeing, let's make data-driven approach. It's probably the biggest buzz phrase in the industry now. But I think what you are seeing this happen, which I think is quite encouraging.
I guess the first thing I'd say is we're not expecting massive change in the next few years. So I'm not sure what the timing of this holistic review will be. But what we do is we look at what's happening now. And we look at, Chair White gave a speech in June in which I think she pretty much laid out an exact roadmap of what they plan to do. And if you look at it, it's going to take a couple of years to implement. The rest of it, not trying to be critical, because I think the market structure overall is good. So first and foremost, we don't want to do harm. So the big issues, the can was kicked down the road. We need to study them. That's the proper thing. We can't make decisions on these things. Steve's speech or congressional testimony, again, elaborates on those types of things. And so I think there's a roadmap out there of what actually is going to happen. It's hard to predict, whether we'll get big change 5 years from now. That's hard for me to do. I bet, like I have the past 3 or 4 years, that we're not going to see massive change in the market structure in the next few years. After that, it's a little bit of a wild card, and also it's always dependent on crisis. If we have more flash crashes, things like that, or stock market crashes, even having nothing to do with technology and things like that, that we could see change implemented more rapidly. We could see Congress get involved. But Congress doesn't have much appetite for this. Bunch of hearings and roundtables back this summer, but that's because they have to respond to Flash Boys. They have to talk about it. They have to be on top of it. And I think the SEC is on top of it. If I think about, practically speaking, what are the things that, as market participants, I can actually see agreement on that we need more of, the first is transparency. Whether it's order routing disclosure or order types, the exchanges have gotten much better there, and we're seeing the SEC, again, in their plan, laying out that there is going to be more order routing disclosure that brokers are going to have to give to their customers. So we're going to see more transparency. That's a certainty, and I don't see anyone resisting that. So I think that's a very good thing, especially when we're in a marketplace which there is this perception of unfairness and darkness that Bob cited. So I think transparency is one we can count on. The second thing that is a little harder to figure out where it's going to end up, I guess we know where it's going to end up. They're doing a tick pilot, a wider tick pilot, but I think everyone agrees that small caps probably haven't benefited to the same extent as the mega caps and the large caps with this transformation. The numbers are undeniable. I know we'll get into it later, but you look at the improvements in transactions costs for institutional investors, and you can look at ITG's numbers, you can look at ITG's competitors' numbers, and you will see very similar trends. Maybe they should have gotten better, maybe they've stalled, that's all true, but the transformation of today versus 15 years ago is undeniable. But with small caps, when you look at certain studies, you look at decimalization studies, you see that they just didn't benefit to the same extent. I'm skeptical that the wider tick pilot is the solution because I think we're going to widen spreads, widen effective spreads, and I don't think we're going to see any real increase in depth. However, I applaud that we're thinking about experimenting with this stuff, especially on small caps. I'd encourage academics and market practitioners to think more about this. One of the things I thought of, which I'm not sure if it makes any sense whatsoever, but if we look at SEC fees and we cut SEC fees for the small caps or eliminate them, it wouldn't have a real big effect on the wallet of the SEC because it's a small part of the market, but might it bring certain liquidity providers in that haven't looked at it before? I don't know, but thinking about those types of things for small caps is something I think most people in the marketplace agree makes sense.
Great, Joe. Well,
So a handful of observations. I think those are all excellent points, and I especially like Joe's because there's a little bit more of a runway for us to get work done. So I don't hear that very often, so I'll take it when I can find it. So Mary Jo did set out her priorities in a speech in June, and we've talked about them as the shorter term and the longer term, and I won't go through the short-term list, but folks have gone through it before. I think we like to think about that not as part of a holistic review, but as part of a process of closing some gaps that need to be closed before you start that holistic review. So that said, I think if we were 3 to 5 years down the road and all we had accomplished was those 4 or 5 or 6 things that we've been talking about, that would bring a certain amount of stability and a certain amount of transparency to the market. But I don't think anybody 3 to 5 years down the road would call that a successfully executed holistic review. So we have to think about how we penetrate into that space, and part of that is how you chunk these issues, right? And so, Bryan said, you look at things, taking them one at a time. I think historically the Commission has done that, has responded to stimuli, and has done that in a very effective way, especially on a lot of the infrastructure things. But, if you take them one at a time, it's very difficult. If you try to do them all at once, it's extraordinarily difficult. You never get anywhere. And so part of this process is how do we, as we are studying these issues, as we are trying to develop data to help us formulate, as we are expanding the circle of people we talk to in terms of formulating things, how do we chunk these things in ways that are logical and are of the right size, where you're minimizing, you can never eliminate, you're minimizing the possibility that when you're doing something in category A, you're going to affect it in category B, and do things that are big enough that you can look at them somewhat holistically, but small enough that you can actually accomplish something in a reasonable period of time. When we first started having these conversations, we got into a debate about holistic versus comprehensive, and I was like, I don't understand what either of them means. So you can pick whichever one you prefer, because I think they all sort of gloss over the bigger question of how exactly do you attack all of this at once. And the last thing I would say, and I'm surprised Bryan didn't jump in here, is, so we're going to pursue the tick pilot, and we've talked about pilots in other areas. We also appreciate, and I think folks have to appreciate, there is a finite capacity for experimentation. Anytime you do one of these things, it's adding even more complexity, with complexity being something we're trying to solve. And so you have to play those levers very carefully. You can't, everybody thinks a maker-taker pilot is a good idea, or sub-penny quoting pilot is a good idea, or the tick size pilot is a good idea. Probably they are all good ideas, but you need to pick those levers very carefully.
Let me just respond to that. Where I guess this is an open question for the group is, when we think about something holistic or comprehensive, whatever you want to say, how do we make sure that if we were to do something that we don't do what everybody's complaining about the unintended consequences of an NMS, which was a watershed moment for the industry. If we do sort of everything in one fell swoop, but whereas if you do things one at a time, granted, the trade-offs are it can take forever to get through, but you have one variable at a time that you're measuring its impact along the way, which I find encouraging. But if you do something that's just holistic and you're making all these changes at once, how do we know that the world tomorrow is better than today?
Right, exactly.
That's why we're still here.
Right, I don't think you do. So that's the art of subsets that you can look at in relation to each other, understanding that that's never going to be perfect, but you do the best you can.
And I think, to the SEC's credit, Greg Berman and his team, and the way they're designing studies, the way they're, it's complicated with the tick pilot. A lot of people wanted to throw in the kitchen sink, but I think they're doing the best. They are data driven. Midas was a great step, and I feel that what we need to be careful of when you go one at a time is just how it's done, because I'll give you an example. So I was down in Congress. This was over a year ago, and I went in someone's office and they handed me something that someone had sent them about a maker-taker pilot. It was very simplistic. Okay, what didn't have the academic rigor that you would want, first of all. And the other problem was they were very interested in getting rid of maker-taker, but their second biggest problem, which I had known because I knew who made this proposal, had been off-exchange trading. That was too high. But their maker-taker pilot was only applying to the exchanges. And I was like, well, you're going to shift flow off exchange if you have a ban on payment for order flow on exchanges, but you don't off exchange. And getting that whole thing through banning payment for order flow is going to be a real challenge. So it was a bit of an unrealistic proposal. So sometimes I think what it is that people, yes, you're right, that we don't want to get bogged down in this comprehensive, holistic thing that just means nothing gets done. That's
right.
what a lot of people feel it means. But on the other hand, if we just choose one thing, you of all people know, we tweak one thing and something else happens somewhere else. So it does take a lot of thought when we pick one of those things to make sure we design it to study the right way, make sure we think as best we can about the consequences. And of course, we never know if we'll get it right, which is the reason I think a lot of us say, well, let's not do too much because it is working pretty well overall, if you look at the numbers.
Yeah, and I think that is always our first thought, which is what are the benefits to the marketplace now, and by making these changes, are we putting any of those benefits at risk? And you need to be very careful, and especially on issues like liquidity and spreads.
Right. So why don't we just discuss in a little bit more detail then the proposed pilot program here for small caps? Because one of the concerns I've heard from people is that wider spreads will hurt retail investors. But effectively, it's just the pilot will introduce a strong structural reason not to trade small caps, and that you're not going to see, it's basically not fair to those companies that get selected in that bucket. Just wondering what the panel thinks of those kind of critiques.
Well, it's basically an anecdote on that topic. Our chairman was hired by the New York Stock Exchange to do and she's, I think, one of the best market microstructure experts on ticks and probably on the planet. And she was hired by the New York Stock Exchange to do a study on tick size and the effect on liquidity. And luckily for her, she didn't give up editorial control because her study found that it actually was not going to have a profound impact on liquidity by widening the tick size. And it really is a macro issue. I mean, we've been talking a lot about, for instance, issues like the equity investor and all. There's a lot of demographic and macro issues at work here too, not just market. We tend to get very focused on market microstructure. But these are macro issues. What's the risk premium, around? What's the risky rate in the capital structure of a small cap firm? So there's a lot of things at work that have nothing to do with market microstructure. That having been said, there's enough energy and there's enough perception and there's the Jobs Act. There's a lot of things going on around this issue or this topic that I think require it to be a focus of experimentation and attribution and being able to go back and say, she's either wrong or right? And we'll look at that. And I think that the SEC has positioned us, positioned the industry and participants and companies to potentially affect that change if it makes sense. It may not, but we're about to find out.
Let me make one statement about that academic work. Interestingly, as you said, as you implied, Bob, that I think the New York Stock Exchange position, they've been in favor of the pilot overall, at least the materials I've read. So what her study showed the opposite.
Yeah.
And most of the academic work, someone had asked me for some information on this, and over the weekend I happened to review a lot of the papers, and the bulk of the evidence would suggest that this is not a fantastic idea. Probably not going to have a huge effect, but it costs the industry. And so, I don't happen to be a big fan. But the reason I mention that with the academic work is that I think one of the things you hear often is, oh, well, those studies that say the markets are better, all were funded by HFT, or they're all funded by exchanges. Some of them were, that's true, and we're actually trying to peel the onion back on that, so to dismiss some of that stuff, because I think some people have got tarnished unfairly in that. But I think there is some good work that's been done, and it's not always in favor of the positions of the people sponsoring it. But what I would say is, back to what you started with earlier, Bob, about the floor. If you think about small caps, one of the problems that we have is the environment changed. We used to have specialists that really supported small cap stocks to win the listings of the big companies where they made money trading in and out. So there was a sort of a subsidy given to those smaller cap names back then. Same thing, I think, in essence, was happening with NASDAQ market makers. They were making money from the research and the offerings, so they would have loss ratios when they're covering a Fidelity. They were expecting to lose money. That means they were giving liquidity when it wasn't the right thing to do necessarily for their own position. So I think we've lost that. Yeah. So with that gone, I guess it doesn't surprise me that small caps have faced challenge, because the reality is they're small caps. They don't trade much. Some of them trade by appointment. So when someone comes in and wants to buy 1 million shares because they think it's a fantastic company, well, if that's 10 times today's volume, yeah, it's going to feel like it's not trading very well. So part of it is a reality of trading small caps. It's always going to be difficult. It doesn't mean that we can't come up with solutions, but the old way of doing it, where there were these kind of artificial subsidies that I think help small caps, are gone. Nothing replaced it. So I think it is true that we need to look at, well, are there things that we can do?
So, speaking from as an exchange, just following this issue over the last 5 to 7 years, we've been talking about this. How do we help the small cap issuer? How do we help the small cap companies? That was a lot. It was at its peak, really during the days when there was like a dearth of IPOs in this country, and now we've kind of had a rebirth, and the IPOs are roaring back. The number of them, I mean, but the same folks who really have been pushing this, and then it got thrown into the Jobs Act, and really Congress latched onto this issue. So but it's funny because as an exchange, and I think maybe you guys would agree, is most people in the industry don't really believe it's going to do that much. But I guess it sort of got pushed down and it took on a life of its own, and here we are, ready talking about implementation. Now, let's not really dismiss all of its potential benefits, but I think really what it's kind of evolving into is not necessarily how do we help the small cap companies, but it's now almost a lit versus dark pilot. So if you kind of follow the complexities of the tick pilot as proposed, there's going to be certain groups of securities. Some everybody's predicting are going to be shifting off exchange. Some are because there's going to be a strict trade at application in these securities. Pretty much going to come all on exchange. So it's going to be a very interesting thing to look at. Obviously, these are not the most liquid securities out there, so we'll have to take the results with a grain of salt. But it's kind of come from a little bit of a capital formation. How do we help these companies go public, support them in the secondary markets? And years ago, the secondary markets were blamed for the lack of IPOs. Nobody's really blaming that anymore. So that's where we are today.
And Mike, I don't know if anyone on the panel has the stats on this. I saw Dave Cummings put out some stats, and he said that each of the 3 buckets only represents 1% of the market cap in the U.S. I mean, so if that's the case, what we're talking about here is affecting 3% of the market cap in the United States. So when we think about, again, it's the big topic, and we're talking about it a lot, but this is certainly not transformational change in and of itself, because it's change that's going to be required of exchanges and brokers to operate systems, yes, and there may be data that comes out of it that tells us something either about tick size or about dark trading, but again, we're looking at, I mean, my guess is we're looking at closer to the first half of 2015 before it's implemented, and then we're looking at a year-long pilot. So all we're talking about is in a year and a half's time, we're going, or so, we're going to have some data that we can look at, but it's only affecting 3%. If that number's right, I don't know if we looked at it.
Right, and it is always important to note that trade at is in there because of a desire to make sure that the thing we wanted to test, we could test effectively, and there is that concern that without a trade at bucket, you would just see more of an experiment on lit versus dark. That doesn't in any way represent a lean by the staff or the commission on view of trade at more generally, in part because that's not what the purpose of this pilot was, but also were you to study it, you wouldn't study it down at the bottom end of the market in terms of liquidity.
Let me just add one thing there, is that the one thing that I worry about is when you call something a pilot. Now, obviously, pilots sometimes get indefinitely continued. Penny pilots and options is a good example of that. But one of the reasons why we were doing this is to help support the issuer, and a lot of that is the ecosystem around it, which is the investment banking. Whatever happened to the regional investment banks from the late 90s, and they started once decimalization was implemented, and then obviously The computer age started to take hold. A lot of those smaller boutique banks started to die off. Then there's the demise of the specialist system down on the traditional floors. So where I'm going with this is that when you set up a pilot, all that infrastructure is not going to be replicated in a year's time or even 2 years' time. If people are saying, okay, if it's only 3% of the names, these are very illiquid names, I'm just going to do the bare minimum I need in order to get my systems ready. But I'm not going to overinvest in trying to help these names because I'm not sure when it's going to go away.
Right, great. So let's turn to the issue of market fairness issues and I suppose transparency. And obviously the New York Attorney General's office made quite a splash recently with Barclays dark pool. What guarantees are there for investors who want to trade in the dark? And let's make it clear that there are legitimate reasons for trading in the dark if you need to move size. You want that anonymity. You don't want that information leakage. But it struck me that the New York Attorney General's office is sort of getting here at an issue where you've got people trading and the rules are different, basically. And that struck me as a key point here, that trading in any market is based on a certain degree of trust. And so how important is the trust issue here when it comes to trading in the dark?
It's huge, and that's really what's at issue here is the truthfulness of what Barclays was doing. I mean, it's still allegations at this point, but one of their defenses is that no one was harmed, meaning that the execution quality was no worse or perhaps better than what people experienced elsewhere. And I found that interesting for a couple of reasons. The first is our own desk used Barclays just like everyone did, and the TCA was good on Barclays. We shut it off just like everyone else did, and I actually commend Bob and his firm. They shut it off just like everyone else did, but then I don't know, I didn't see the full thing, but I believe you put it back on because you said the quality's there, and you probably thought to yourself, if anyone's going to be honest right now, it's going to be Barclays with everyone crawling all over them. But I think a lot of people right now are reluctant to turn Barclays back on. They did the normal penalty box thing. Oh, we feel lied to. Okay, so they're in the penalty box, and they want to figure out what's going on. But now as the dust has settled a little bit, it's interesting. We do market structure roundtables with the buy side, and we did one in Boston 3 weeks ago, and last week I was in San Francisco and LA. So we probably met with 36 buy-side traders, and several of them specifically mentioned that their transaction cost analysis for Barclays was very strong, and no one else raised their hand and said, "Well, mine stunk, and I was by using them I got hurt." That's very interesting because what it's suggesting at least is that it's not so much about the end result, like we were talking up here earlier, that hey, results are better than they ever have been for retail and for institutional. But if the complexity is there and the fear that you're getting ripped off, and maybe there's actual dishonesty happening, well, then we have a real problem. So I think that when I think about disclosure, we've been harping on this for years about order routing disclosure. We've seen tremendous progress there. We have exchanges with much more information about their order types out there. We have ATSs with voluntarily disclosed Form ATSs. But that needs to go further. And we have MIDAS at the SEC. We have lots of positive. We have FINRA revealing the dark pool data on an individual security basis. All these are positive steps. But they're just the beginning because Form ATS is something that is written by lawyers for lawyers. It's not all that useful at this point. So the SEC in Chair White's speech, she talked about beefing up that disclosure, really standardizing it. She clearly spent time, and it's a real thing I know the SEC is working on intensely at this point, is a standard form of order routing disclosure that brokers must provide to their customers. So we're going to see, and FINRA is talking about adding the wholesaler data to their disclosures that they're doing now, and they're also talking about maybe order book disclosure of some sort for ATSs. I'm not sure what form that's going to take. That could be problematic, but the point is everyone's working on that aspect, and I think that's crucial because even in situations where we can show that the market is better, or in this instance that maybe Barclays executions were just as good as, if not better than anyone else's, people are still up in arms for good reason because they don't feel they're being told the truth, and that's always been a problem with Wall Street. So I think that's definitely one of the key items we have to focus on as an industry.
Well,
I'm sorry.
it's not
Sorry
just
for that rant.
it's not just trust, right? It's comprehension, and Joe's absolutely right. There needs to be greater operational transparency around ATSs, and investors should know how, institutional investors should know how their executing brokers are routing their orders. But then when they get that level of information about where their orders go, they should understand what that means, right? So if it's going to dark pool A or dark pool B, they should be able to have the information that allows them to decide, is that someplace where I'm happy with the trade-off of execution opportunity versus the possibility of leakage, or am I unhappy? And have that conversation and conform those routing decisions accordingly. So a level of transparency, sort of a 606 for institutions that's not dissimilar to what exists, or hopefully somewhat different than exists for retail orders, as well as a level of understanding of what the different venues are and how they work, I think will enable a lot of productive conversations. I would also say at this point, I'm confident I know less about the facts of Barclays than anybody at this table, and I just want to make sure that that's clear.
Yeah, I think this is one of the areas where I think the transparency area, I think, is where the narrative in Flash Boys gets disrupted a little bit in terms of the facts. As a firm, we've been providing venue analysis back to institutions, our institutional clients, globally since 2010. So when you have a question about, how does XYZ ATS perform, how does it reversion, I think is kind of a fairly rudimentary measurement of toxicity. And by reversion, I mean, in little buckets of windows, you're a buyer of stock. How are you moving that stock, and how does it revert back when you disappear with your buy order? That's, in a rudimentary kind of way, that's the way people describe sometimes toxicity. So, all of those categories that you would think folks cared about, we've been providing back to 2010. In our own algos and our own smart router, we've been providing that real time through a product called Prism. We introduced it, actually fortuitous for us, in mid-2013. And really, it's a piece of software that when you enter our algo suite globally, you have the ability to see where we're placing orders, where we're routing orders real time. And so you can say to us, well, why are you layering the offer in bats? Are you trying to basically collect a rebate? No, we're not trying to collect a rebate. That's part of the algo strategy. That's part of what the smart router does, and let us explain to you why. So it's been a great tool in terms of communication, transparency, disclosure, all of those things. So those tools, I mean, there are a lot of our clients, as I know the guys on this panel are very aware, a lot of our clients are storing petabytes of data in terms of liquidity, venues, and analysis. They're not sitting there in the dark and being walked off a plank by the sell side into shark-infested HFT waters. They're looking at this stuff every day. It's the free market force that exists out there. These guys are fiduciaries. They're not living in a mushroom cellar.
And the
right?
2010 date that you cited is an important one, because I think it really, after the pipeline incident, I think brokers were reluctant to give certain information. They didn't want to give up their special sauce of their algorithms where they were routing. There was a lot of times when people sought information that they'd get, oh, we can't disclose that because we have an NDA with someone, that type of thing. After pipeline blew up, I would say brokers have gotten very, very strong in front. And the same thing with exchanges. When people started claiming that there was leakage from certain order types and things, at that point, exchanges and the brokerage community, respectively, and with those two incidents, really stepped up their game. And I think there's a bit of unfair, throwing of stones on some of this stuff, because it's very complex as part of the problem. So to describe the way an order, we did a report on order types that was 56 pages, and it took our guy who wrote it 4 months to research all. I'm sure he was talking to you, Brian, and everyone else, and it's a lot of work to understand it. So part of it is the complexity, and it's not necessarily people hiding the information. Sometimes it's just hard to understand because of the way it all interacts. So, but I do think since 2010, we've seen a market improvement, and it continues to improve. And what we're seeing now is we're going away from the voluntary disclosure to more mandatory disclosure, which probably is a good thing in the end, and I think most people aren't objecting to it, in part because smaller asset managers or smaller brokers who maybe don't use certain products as much maybe have a little harder time getting the information, or maybe they have the harder time getting the resources to analyze the information. And when you have standardization and all this collected, what you're going to see is vendors coming out and offering more analysis. People like ITG have been doing it for a long time on a product basis. We've been doing it on a custom basis for a while. But I'm excited to see standardized information because then we can more productize it and go out there more with a regular product or service rather than having to sort of recreate the wheel based on the data that someone has collected, which is sort of the boat we're in today.
And if you look at the retail experience, right, standardization didn't necessarily lead to the cottage industry that everybody thought it would, but what it did lead to was a level of competitive, comparative transparency where everybody was looking at everybody else's numbers, and that level of competition was the transparency around the competition, I think, served the purpose. So 605 and 606 I don't think worked entirely the way the commission thought it was going to work, but it had the same benefit at the end of the day.
Great. Well, let's look at the topic of SIPs, because that was raised by Commissioner Gallagher this morning, and I thought it was very interesting because, again, it's another issue which people like to talk about, and in particular, the sort of speed differential between the SIP and the direct feeds from the exchanges. I mean, what should be done? Should the SIP model be discarded? Is it outdated to have a utility type and we just have all the direct feeds fed into a third party? Everyone then kind of has the same speed?
Well, yeah, it's interesting. It's an interesting issue from a practitioner perspective, right? So one of the issues you have, we manage both SIPs and direct feeds. So this is not about.
As does everybody.
As does everybody, right? I mean,
this gets back.
And let me tell you in the real world why the SIP is still important. And the reason it's important is because the market data vendors coming in through the screen, Bloomberg, Reuters, et cetera, all provide SIP data, right? So when someone...
It's also important because it's the regulatory benchmark.
Exactly. So you've got this yin and yang kind of pulling in different directions. That needs to be unified. I think Commissioner Gallagher is absolutely right. There needs to be an industry standard. Let's go in that direction. Boom. Now, but that has implications not only for broker-dealers, it has implications for vendors and exchanges and a lot of other parts of the ecosystem. But the SIP today is the reason it remains is because of that, right? A lot of folks in our position, and I'm sure other guys in the business, we manage direct feeds in our algos and our smart order router, and we have to be lowest latency, right? Because we have to compete for liquidity with HFTs every day. That makes us better, to be honest. So, but there's this SIP issue where sometimes you'll see something in SIP that is off sequence versus the direct market data feed, and vice versa. So you'll say, oh, geez, what happened here? Why is this block printing here when it looks out of sequence? But it's a SIP issue. It's a hiccup. It's a hiccup in the consolidated or aggregated amplification of that data out to the community, right? And the big hiccup was last year with NASDAQ in August of 13. That was a big hiccup. But let me compare and contrast that to Europe, right? Europe does not have a consolidated tape. It is a nightmare. And one of the biggest mistakes that the regulators made in Europe was they did not deputize someone to basically manage the market data feeds, right? And there was I think they were trying ultimately to avoid the exchanges in that capacity. Well, why not the exchanges? The exchanges are the best utilities on the planet for doing that. But they could be one of relative to other folks as well. There's probably a lot of guys that are qualified to manage that. So you ended up with this boat thing, and then and TCA is messed up, and you have to manage as a broker. You have to manage your own feeds in a very, very different way in Europe, and it hasn't done anything for market confidence, that's for sure, in terms of institutions or retail. So that's a bad example of what to do. In the U.S., I think we're at a stage where I think given where latency is, given the importance of uniformity and transparency, all the things we've been talking about this morning, it's the right time to address it and to come up with one unified. But that's the real world application here. So when people say, "Oh, it's about brokers trying to latency arbitrage their clients," are you kidding me? Come on. That's so far off the radar in terms of the facts, right? It really is about what the client's seeing in front of his screen and what you're providing him in terms of execution, right? And that's the real world application of what we're talking about here.
So the SIP, Commissioner Gallagher talked about its origin and back to the 70s, and it's really you look up utility in the dictionary, and SIP is a great example. So utilities have a lot of benefits in that it's standard, everybody understands it. As Stephen said, firms use it for, it's the regulatory benchmark for what's the public quotation. Then also, but the trade-offs with a utility are sometimes they're not always kept up to speed with the pace of innovation. Anytime you have to collaborate, so all the exchanges publish their quotes, and we have this committee that governs the SIP. And obviously, the exchanges don't always agree on everything, and you have two exchanges in particular that operate the SIP, but they also have a business that's very, very competitive. So there's all kinds of issues there that really what the SIP is today is much different than what its intention was back in the 70s. Utilities can also be prone to be expensive. If you're not, what is great about private forces and bringing out competing products is that, speaking from BATS, we like to be disruptive, and we'll throw out a price that we think can set a new price. I don't mean the actual stock price, but a price for a product. So if we want to roll out a new data feed, and we might want to make it really, really cheap in the industry, let's let market forces drive the appetite for that. But with that said, the SIP is 100% important, and the longer really the lack of investment in the SIP, the longer that kind of took place, and as private innovation has really accelerated, then that gap gets wider and wider, which we as an industry, it is time to address that. And then obviously there's the single point of failure issue. What's great about technology and what's great about today's market structure is that we back each other up. If BATS would have a failure, or NASDAQ were to have a failure, we back each other up. We can trade each other's securities. The SIP goes down, as happened last year. Really, the market everybody was, first of all, confused, and some firms stopped trading, others kept trading, but that lack of a benchmark and not having a backup to that benchmark really hurt the market that day.
I think the robustness point is a great one, and it needs to be a low-cost utility. It needs to be, but at the end of the day, we need, as you suggested, Bob, in terms of the problem with Europe. Europe complains there's no consolidated tape. We don't know. We can't do proper TCA. The regulators need a benchmark. People to evaluate their trades need a benchmark. So as long as the speed is close enough to what someone could do commercially, putting all the different feeds together, as long as it's robust, as long as it's not too expensive, I think it makes sense to have it as a utility, me personally. And I think one of the things that's lost when people think about the SIP is they don't quite understand how it works. The reason the SIP is slower than the feeds is because it's consolidating 11 different feeds. So it's doing an extra step, if you will. Mm-hmm. By the way, every HFT or every algo provider does the same thing. They consolidate those when they don't use the SIP. The fact is, yes, there are going to be people faster than the technology provider you choose at a point in time. People are going to get faster. I don't see how you avoid that. I don't see how you avoid it with multiple SIPs. The guy who his livelihood is dependent more on speed than another guy is going to make sure he hires the best scientists, the fastest servers, buys FPGAs, does everything on the coding right to be faster. You can't eliminate that. So it's not a question to me of, you can pick a point in time, say it's unfair that certain people start fast, but I don't know how you actually do that, make people start at the same place, because people are going to spend time and resources, whether it's the SIP or some other element of the market structure. So I don't worry too much about it. I worry about the robustness, because I don't want to have prices not be available and people think the market's broken. I worry about that the speed is close enough, because if some people are using it for dark pools and ATSs, if there's too great a disparity, it leads to latency arbitrage and things like that. But at the end of the day, there's a reason it's a utility, just like we have phone systems and the internet. We have these debates in those industries as well about opening these things up. And how competitors can use them. But I think if we have robustness, we have decent speed, and we should improve it, and it's not too expensive, it's a good thing to have.
So, yeah, and a couple of things. One of which is the robustness point is where you should start this conversation. And I think, again, Bryan can speak to this, but the SROs have done a ton of work in the last year since the NASDAQ SIP issue to help in that, including creating, hot warm backups, so whatever. Were there to be, one would hope that a SIP outage is much less likely now than it was a year ago, but the impact of a SIP outage is much less dramatic than it was a year ago. But I also, I agree. It's part of it is there a fundamental fairness question about receipt of information, and part of that is you're never going to be able to get to a perfect tie. But at the same time, I think in terms of a fundamental decision whether you're going to ingest the SIP or spend the money to ingest the direct feed, there should be a level of transparency around that about the differences in the speed. And there should also be a requirement on the providers of the direct feed, or also the providers of data to the SIP, to make sure they're doing everything they possibly can to make the SIP as competitive an alternative as possible.
Great, thanks, Stephen. So let's turn to it seems to me that we've got this very much steady as she goes type approach to looking at Reg NMS, the consequences, pilot programs underway. But equities don't exist in their own pool. There's very actively traded ETFs, and then you have a very actively traded futures and options markets. And you have these pools of liquidity that are interacting and affecting each other, and yet we hear a lot of talk about robustness and trust. Just wondering, if you're going to look at a holistic review and look at the equity market, you need to really look at everything. And is enough attention being paid to what's happening with futures? And I know we have different regulatory regimes here, but it strikes me that the growth of ETFs and the growth of futures trading and options trading in particular, if you look at the growth of options on VIX, for example, which has come from nowhere. How is that being addressed and played out and thought about when we've got this very already complex equity market structure to begin with?
Yeah, look, I think that is a challenge, and Dan continues to give me a hard time that I only have 3/4 of a person working on the corporate fixed income market, but he's a very, very good 3/4 of a person. I think that's important to point out. But ETFs is a market that is also growing and has a retail component and has a sales practice component and a variety of other things. And there are some issues that are specific to ETFs there are some ETF issues that very much are alongside the issues we're worrying about in the equity market space. But then there are a whole separate set of issues around ETFs that are fundamentally different from some of the core equity market issues that are considered part of the quote-unquote holistic review. So it is back to the question of, if you do things in isolation, you create unintended consequences. If you try to do everything at once, you never get done. So that works for options and ETFs. The futures overlay is real, and there's nothing we can do about that because that's just a separate regulator. But we're constantly having that debate about how do we chunk these issues as we analyze them? How do we make it not so small that we're obviously missing real interconnections, and how do we not make it so big that we never get done? And it's a constant debate.
I want to take a step back from your question in terms of the interaction of these instruments and just talk about the sort of markets in general. And Commissioner Gallagher touched on it, and we'll have a panel at the end of the day about this. But when you compare, say, the fixed income and the FX markets to the equities markets, I mean, there's no comparison in terms of the pre-trade and post-trade transparency. So, and the same HFTs and dealers play in both markets. They just make a lot more money in those other markets, and frankly, I think rip people off a lot more. I'm not saying there's not things that are happening in equities or options that don't need to be corrected. They do. However, the results, and I think you're about to see some of it. I mean, we just saw the FX thing seems like it's bubbling up, and we've got OCC and the Fed looking like they're going to settle some investigations with the banks on the CME, and we'll hear from them later. We've got an arbitration case with Alston, a big HFT firm that allegedly is spoofing in some way between the U.S. Treasury market and the futures. I mean, these are big things that are beyond what we've seen in equities. Frankly, the equities cases that you've seen where people have gotten in trouble have mostly been small day trading firms. You really haven't seen a big HFT get nailed for anything like market manipulation, et cetera. At least I haven't. But we may be about to see that in the FX market with the dealers, and we may be about to see it in the Treasury market. Again, these are allegations, so what do I know? But there's I think no one would deny that the level of pre-trade and post-trade transparency in equities versus these other markets is sort of night and day. And those markets have improved, and of course Dodd-Frank is pushing things, at least centrally cleared, but maybe on exchange there might be more. But we see the CEFs not doing very much volume, for instance. So not to deflect attention from the equities markets, that's what we do. We care about them immensely. It's important to our capital markets, and they can be improved. But if we look at, no offense to you, Steve, right, that you only have 3/4 of body devoted to that market, and the amount of you're spending on equities, it's
a full 5% of my time. So.
Yeah, and it is what hits the papers and what people want to talk about. But these other markets have, I think, bigger warts than the equities markets.
Yeah, look, I don't think there's any question about that. And part of it is, the equity markets are the topic of conversation. But I say this all the time, especially in the retail space, execution quality. It's hard to imagine that there really is space for material improvement in that. I think obviously on the institutional side, it's a different analysis. But you compare that to the retail experience in the fixed income markets, it's night and day. And so you really, obviously we're gonna dedicate a substantial amount of resources to the equity market structure issues, but we can't lose sight of the other markets that perhaps need even more attention.
Yeah, I think we've been doing a lot of work on the FX side in the last 2 or 3 years, and I think the fallacy we found is that when you first approach an institutional investor, and really what drove this was the custodial issues that started hitting the tape around the bundling of custody fees and trading and FX trading, and it caused an explosion of, at the end, pension plan sponsor. They started asking all the right questions about okay, you're bundling custody, but how does this all work, right? So you're giving me a very small ticket charge for every trade I do, but you're making it back and more on the FX side. So that unleashed the same things we've seen in equities, which is this pursuit of transparency in terms of FX execution quality. And what we found in our data, as we built out the data set over the past several years, is that really is a fallacy. That it's a big market, but it's certainly a market that continues to be controlled by an oligopoly of balance sheets, right? And it's very antiquated in terms of, it's not antiquated, I'd say, it's not nearly as efficient as the straight-through process that we have in equities, right? So it creates a lot of frictional costs that folks don't really understand quite clearly yet. There's a lot of energy around the fixing and manipulation and all those things, but there's bigger issues in FX, much bigger issues. Than I think even you're reading about in the paper. And that's coming out in the FXTCA data loud and clear. And I think institutions are starting to step back and say, listen, I'm going to take more direct control over this process than I have in the past. I have a fiduciary responsibility to do that.
And unlike me, who just trades equities and options, Bob's firm is in these markets and is one of the experts in transaction cost analysis. And I saw you're doing fixed income as well. So, they're looking at all these markets, and again, the differences are pretty stunning.
Yeah, and I think that will drive, there's one of those free market forces that will drive change, structural change. And I think clearly when you start to peel back the layers of the onion around the fixed income market in the U.S., investor protection is, whoa. If you go into Trace and you see these odd lot trades that are trading at massive spreads, they're coming into bulge bracket retail shops, they're being churned and burned and thrown back into and as we consolidate the data feeds that are really kind of central to our new dark pool in fixed income, we see much tighter markets, right? We see a market that, we're taking it from ATSs, we're taking it from Market, KIT, we're taking it from IDC, we're taking it from a variety of different sources and coming up with an aggregated, almost like a SIP-like feed for basically the beginnings of a negotiation in the U.S. corporate bond market, the first dark pool in the space. And we spent 2 years building that aggregated price, that quote. And when we compare it against these trace trades that are happening at big spreads around the bid offer that we see, you say to yourself, wow, this is a market that is ripe. And as the chairman, I think, correctly pointed out a few months ago, this is a market that is ripe for change, and certainly probably a little bit more oversight.
Yeah, no, I think that's absolutely right. And I know Dan quickly referenced what MSRB and FINRA are proposing in terms of a level of transparency around matched pair trades in a day. I mean, to me, it's just a tiny baby step, but you do still see so many incidents of the dealer in and out in a single day with a substantial spread between those two prints. Look, all of which is already available on Trace and Emma, and to a certain extent, right. You could just tell customers, well, it's out there and it's free and it's public. You should figure it out yourself. But that's clearly information that one's broker should be pushing to their customer. And having to push it and having to defend it, I think, has a nice conforming effect on some of the prices in those trades.
And so, yeah, I think what you'll hear from some asset managers, PIMCO and BlackRock, later in the day. And I think what you'll hear from them, and I think the other kind of free market force here in fixed income is that the liquidity in the corporate bond market, and we all see the train, it's coming. It's just a matter of how far away it is. We can hear the whistle. There's going to be a correction in the corporate debt market. It's just, when is it going to happen? And for them, this issue is a strategic issue, because what it really speaks to is the capacity they have to invest in the U.S. will be constrained by Dodd-Frank and Volcker and Basel III, all the things that Commissioner Gallagher talked about. This is a big issue for the what I would call it's a big issue for their ability to continue to invest in these markets on behalf of retail and institutional investors. So, there's not a bigger topic for them today. I think, at least, and you've seen it. They've been very declarative. They put out a lot of thought pieces, white papers, and they're very, very concerned about the future of the secondary markets.
I suppose the other big issue too, though, is that every company has its one equity price. But particularly corporate treasurers, love to issue bonds whenever they feel there's an opportunity to issue bonds. Hence, I think Citigroup, for example, has like 96,000 CUSIPs for bonds, all the various bonds and floating notes it's issued. So it's very difficult to apply that electronic trading model to a market that is so fragmented.
There's truth in that, but I would also say that the U.S. options market has similar characteristics and really has gone electronic over the past decade or so. So historically, that was the case, that you had to find the liquidity from the dealers. You didn't really see many agents participating in the market because it was a principal-based market. It wasn't really exchange-based. But ISE took it electronic, and really, even with the liquidity issues, I think that market has transformed and become a lot more transparent than it was 10, 15 years ago. So there's definitely resistance because of the issue that you say, and that the dealers do have some ability to resist change. But I do think it's possible, even in the illiquid instruments, to see a more transparent market like we do in options. I don't know what you guys think. You guys are in this market. What do you think, Brian?
Well, that's a perfect analogy, is the options market. Just think of how many strikes and series and just expirations are added. Now, obviously, it's all top heavy as well. It's like the old 80-20 rule with anything. You see in the treasuries markets, so really, as far as fixed income, treasuries are the only product that has really been truly adopted from a purely electronic basis. So I do agree that it is by appointment only. The more kind of different, not to use the word derivative, but issuances you have, then obviously you're going to be trading by appointment, and you'd need the dealer capital commitment. However, we heard, I think there was one lady in the audience who talked about kind of the disclosure and sort of the opaqueness. Market forces are going to drive change, and that will eliminate sort of the old club atmosphere that we're seeing.
But look, part of it is you have to incent a class of dealers to provide liquidity and take positions. And so the options analogy works to a certain extent, but there's always plenty of ways you can hedge an options position. I think what Dan alluded to briefly when he was talking about was some level of fungibility, some fewer asset classes, not just fewer fewer classes, not just in terms of complexity, but in terms of the ability to have some level of fungibility and some ability to hedge. But that actually, you got to figure out how to incent the CFOs and the corporate treasurers that it's in their interest to do fewer, not more, when at this point it's very much in their interest to do more.
The other thing with corporates, I think, based on what I've seen, is that unlike options that are trading vehicles and hedging vehicles, in corporates, they can be that, but oftentimes people are putting them away. So a pension fund buys some, whatever Disney corporate, and it's sort of in their portfolio for the next 20 years, for the life of it. So that liquidity doesn't end up back on the market. So even if you have principals willing to make markets, there's nothing.
That's right.
There, no inventory.
Right. The issuer is happy for this to trade a certain amount in the first 6 to 12 months and then come to rest for the remainder of the life of the instrument.
Right. I think we've got some time left for Q&A. So if anyone in the audience would like to ask a question of the panel, please raise your hand. And I think someone's got a microphone somewhere. Looks like everyone wants to go to lunch.
Bob, I had a question for you. So tell us a little bit more about the bond dark pool that ITG has started.
Yeah, so we disclosed that a couple weeks ago that we've made a revision to our ATS that to trade fixed income U.S. corporates at high yield, investment grade and high yield, and it's now in the public domain. So I think we're the first bond ATFs to put out our filing in the public domain, which is good. It's basically an effort to create something similar, but certainly we respect the differences and the nuances of U.S. corporate bond market structure relative to equities, but very similar in terms of its institutional. It's going to be basically point-in-time matches. We're pricing about 11,000 securities minute by minute. It really comes down to, as these guys were talking about earlier, 3,000 or 4,000 names that really are on the run before they disappear inside an index and you never see them again. So that really is the if you think about the integrity of pricing and price discovery, it really is focused around those recent issuances, and there's a lot of activity there, and certainly a lot of inefficiency as we've been discussing. But I think we're going to take advantage of the fact that we can clear these trades because we're a DTCC member, so it'll be completely anonymous to the two counterparties. So we'll be a dark pool, and we'll do point-in-time matches, and then ultimately our goal is to start to sweep blotters the way we do in equities. So in other words, take the buy-side blotter and create matching opportunities real time between institutions. So it is a blueprint that I think looks equity-like. But certainly the biggest challenge, and the reason there are a lot of folks very credible folks who stood up in the marketplace and said a dark pool will never work in U.S. corporate fixed income, and that's a great challenge for us. We'll go after that any day of the week. And so, yeah, we understand that, but we have invested quite a bit in creating, as I described earlier, that SIP, which really will create, I think, the first of its kind in terms of the ability for two institutions to come together and start to negotiate a price that has some integrity relative to other participants in the marketplace. So give them a little bit more confidence to act. Traditionally, the buy side have been what I would describe as price takers as opposed to price makers. This will put them in a different driver's seat than they've been in before.
You hope.
I hope. I hope. But there's going to be a lot of evangelization and a lot of challenge and a lot of hand-wringing and people saying never be done.
Is there a movement afoot to add the ATS execution venue to the consolidated tape? And what's the status of that? And do you...
You mean as a named entity as opposed to the rolled up volume reporting? I don't.
Well, the venue right now is the TRF,
right, the TRF.
To which that ATS reports. I think FINRA has, as somebody else alluded to, FINRA has started to create more transparency around what's happening in the OTC market. That just started with consolidated ATS volume on a delayed basis. It's now going to greater transparency around how much additional volume is being done by entities that have ATSs but also trade over the counter outside the ATS. I think at some point as we've pushed for greater transparency of the operations of ATSs, that is a reasonable thing. I think there's probably some technological complexity that goes with that. If you've gone from having a SIP that is basically collecting 12 venues to 50 venues, that's not something you can do overnight, and so you have to decide there's a real value to understanding that it's this ATS versus that ATS. It seems to me that until people can actually understand the difference of what happens inside of ATSs, that's information that's interesting but not terribly useful. So this first step is greater operational transparency around ATSs, and then maybe greater transparency on the tape of what ATS the trade was actually done in when it was done over the counter.
I think ATSs these days have become like mini exchanges in some ways, but the original intention of dark pools and ATSs is to move institutional order flow with low impact. So the key issue with that, with reporting, especially real-time reporting, is are you going to expose an institution, even if you're masking that institution's order on, say, ITG or Morgan Stanley or Goldman? Can people pick up on patterns and reverse engineer? So I think the brokers, from my opinion, and institutions have been resistant to that. That's why you're seeing it on a delayed basis. I think it's 1 week delayed on the FINRA website. So people want to understand how big different ATSs are, what types of liquidity they have. But really, right after the execution might be a little too close to the point of trade.
Just to echo what Brian's saying, we don't really hear any demand either from the sell side who operates these, who doesn't necessarily want to put that information out there real time, nor from the buy side. So I don't see any great, we see demand for Steve was saying, for the information that can help with order routing, because you could do ex post analysis and determine that you're getting good fills here, you're not getting good fills there. But outside of that, it seems like that issue kind of died.
Yeah, although I think, the absence of buy-side demand could change when there is less opacity about what's happening in the over-the-counter market.
Great. Well, thank you so much, and please thank the panel.
Steve, you too.